To question D, we're being told that the general partner for the private equity fund charges a management fee of 2% and carried interest of 20% using the total return method. The total commitment capital for the fund is 150 million, as in 150 million is the initial amount of money that has actually been distributed or been used for investment in the private equity deal. The following data relates to the above equity fund. So we have the year there from 2010 to 2015. The capital called down has been given. The cash flow operating results have been provided, and as well as distributions. So required, they want the residual value to paid in capital computed to us there. So in this case, what we will have to do, with your permission, I will be able to, because we want to draw a table over here, I will be able to first of all have to rub until this entire part right here, so that we can be able to comfortably do this question or solve this question. So what we need to do first is to write the year 2010 2015. Then we have the capital called down. There. So the capital called down, we've been given there 50, 20, 30. 20, 10, 10. Now, once we have the capital called down given to us, we don't just continue putting the cash flow operating results. There's a structured way in which we need to do it, because we need to first of all calculate the carried interest component. We also need to compute what we can call term as the paid in capital. The paid in capital is just the cumulative sum of the capital called down. Cumulative sum of the capital called down. So in this case, we have 50, we have 70, this is 100, 120, 130, 140. I say that this column is just the cumulative sum of the capital called down. Once we have the paid in capital there, we need to now slot in the management fees right over there. The management fees there. And what have we been told about the management fee? We are told in the first statement there that the general partner for the private equity fund charges a management fee of 2% and carried interest of 20%. So 2% of this value gives us how much? So that's what we need to calculate right over there. So we are saying that we need to calculate 2% of 50. 1. 2% of 70, 1.4. 2% of 100, that's 2. Then 2% of 120, 2.4. 0.02 times 130, 2.6. Here we have 0.02 times 140, 2.8. That is how we compute the management fees. You've been given the percentages there. And management fee is always computed based on the capital called down, not on the paid in capital, not on the capital called down there. Now we have the management fees. Now we need to now slot in the operating results. Operating results have been given to us in the question. There you can see the operating results. You have minus 10, minus 10, minus 25, 25, 50, 60, 110. 110 there. Once we have, because that one we've already been given. Now the operating results, we next column is the net asset value before distribution. Before dist. Can put it like that. Up to that point there. Net asset value before distribution. I will be able to explain how we've actually gotten them like that. The net asset value before distribution, we can say NAV before distribution is given as NAV after distribution in prior year, NAV after distribution in prior year, plus the capital called down, the current capital called down, capital called down, then you less these management fees, plus operating results. Like that. Higher. Let's, for example, do for the very first one there. Net asset value after distribution in prior year. Now it's the very first one, so here we have 0 plus the capital called down, which is in the current year 50 minus management fees of 1 plus operating results. In this case, it's minus 10. Like that. How much do we get? This is 50 minus 1 is 49. 49 minus 10 is 39. Got it? Let's do this second one right over here again. Now, this one, we want the NAV after distribution in prior year. So we first of all need to complete this so that you can be able to get the net asset value after distribution right over here. So in this case, since it's the first case, we could not be able to get the net asset value after distribution in the first year. So what we do, we continue right over there. We need to get the carried interest. Carried interest is only paid when the capital called down exceeds the committed capital. So when you look at this NAV before distribution, when you get these values over here like this, at the point where you see that this value exceeds the committed capital of 150 million is when carried interest will actually be paid there. So we'll wait and see that. So that is the column for carried interest. Then we have distributions there, and the distributions have already been given to us right over there. And third from bottom, and we have 20, we have 40, and we have 80. Like that. After distributions, now we have the final column, net asset value after distributions. That. So here we don't have carried interest, we don't have any distribution over here. Why? Because we are saying that when this point exceeds the 150 million, because we have been given the 150 million in the question right over here, we are told the committed capital of the fund is 150 million, and we are waiting to see at what point this column over here, if I may use a different color right now so that we can be able to know what we're trying to look for. Though this is the column we're trying to focus on. Yeah. So at this point where you see the value exceeding this 150 million, that is when you'll be able to start seeing carried interest to be paid. Now this column will start actually being populated. So here we don't have anything, so we have 39 there. Now we are getting back to this point right over here now. We want to calculate the net asset value before distribution. So it's net asset value before distribution is net asset value after distribution in prior year. So in the previous year we have 39 plus what is the current capital called down, 20, minus management fees. Management fees we have 1.4 plus operating results. In this case, we are minusing 25. That. So let's see how much we get there. So we have 39 plus 20 minus 1.4 minus 25. 32.6. Sorry, this pen over here, 32.6. In this case, not yet. This value has not exceeded 150, so we have dash dash. We put 32.6. The third case, I can be able to continue right over here, 32.6. Then we add. So if it will allow me right over here, I can rub off these ones over here because we've already done the values there. So we're saying now we are here 32.6. 32.6 plus the capital called down, which you're saying is 30. Yes, 30. Minus management fees, here we are saying is 2 plus operating results of 25. Is it 75 or 25? Let me see. Is it 25? Yes, I can see it's 25. Right over there, this is 25. Like that. So once we have that, we just try and compute. Just compute. 6 plus 30 minus 2 plus 25, 85.6. Not yet. 85.6. Higher. We have 85.6 plus the current year now is 2013-20 minus this one over here minus 2.4 plus operating results is 50. 5.6 plus 20 minus 2.4 plus 50. 153.2. So at this point right over here, 153.2, I need to highlight that, please. 153.2, at that point right there is when it exceeds this committed capital right there. That is when you're supposed to see carried interest. The computation for carried interest now, because at that point has already been exceeded, we can be able to have a small working right over here. So carried interest is now the difference between the committed capital and this net asset value before depreciation. So we say it's going to be 20%. The question said it's 20% multiplied by the difference between 153.2 minus, which is this 153.2 minus the committed capital 150, like that. So that's when you're going to populate and start populating this point over here. So 20% of 3.2. 0.2 times 3.2, we have 0.64. 0.64. Higher. Now you can see the carried interest exists, the distribution exists. Now we need to get the net asset value after distribution. So that means it is 153.2 minus 0.64 minus 20. 132.56. 132.56. It's deliberate why I'm using red right there, because at this point is where now we are going to see a difference now. Now, how do we get this value right over here? We just go back to our formula right down over here. The net asset value after distribution in the prior year. So in the prior year, it's 132.56, not 153.2, because we've deducted these two. It's 132.56. 132.56 right over here, plus capital called down in the current year. The capital called down is 10 for the current year, so plus 10. Then we less management fees. Less the management fees, we are looking at this year right over here. Less the management fees, 2.6. Then we add the operating results, 2.6, then we add 60. 199.96. 199.96, like that. How do we get the carried interest? The carried interest, we come back over here. 20% multiplied by now. Now we are saying we are going to get now the difference between this 153, the above value, and this value of 199.96. This is the same as 200, like that. So we say 199.96 minus 153.2, not 150. 150 related to this part over here. 150 is the committed capital, like that. So how much do we get right there? So we have 199.96 minus 153.2 equals, like that, times 0.2, 9.35. So we have here 9.35, like that. So please note that that's the 9.35 there. Now we get this minus this minus this. How much is the net asset value after distribution? Right there. So we have 199.96 minus 9.35 minus 40, 150.61. Now we come back to the final row there. So it's this value over here, like this. Then we add the capital called down, we less the management fees, we get the operating result. So that's how we get this value right down over here. So we have 199.96, like that. 150.61, pardon me. We're looking for the net asset value in prior year, not the previous one over here. It's this one over here because we've less the value. So it's 150.61. Then we add the capital called down for this current year right over here, 10. Then we less the management fees for that year is 2.8. Once you less 2.8, we need now to now deduct. We add, 110 plus 110. 267.81. That. How do you get carried interest? Which is based on this value. So you're saying it's 20% multiplied by 267.81 minus 199.96. Like that. How much? Minus 199.96 times 0.2, 13.57. This minus that, how much do we get? 267.81 minus 13.57 minus 80, how much? 174.24. Now, having gotten that, we now need to compute. We've been told to calculate the residual value to paid in capital. Now, to compute the residual value to paid in capital, we just need to get the net asset value after distributions, the 174.24, and then we can be able to divide that value by the cumulative paid in capital right there. So, if I'll be able to, you can allow me, I can rub on this other side here so that we can be able to answer the question. So residual value to paid in capital. Value to paid in capital. RVPI, residual value to paid in capital, is given as the net asset value after distributions, NAV after distributions, divided by the cumulative paid in capital. So in this case, we are saying is the 174.24 right over here, the 174.24 right down over here, divided by this 140 right down here. So it's 174.24 divided by 140. How much do we get? So it's 174.24 divided by 140. We have 1.2 245. That is the residual value to paid-in capital right there. Now, this brings us to the end of question 4. We hope that you'll be able to join us for question 5 as we conclude November 2015 block release. Thank you and God bless you.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.